Hello everybody, my name is Darren Shane Sutton, and I'm about to share with you my final presentation for BA403 Capstone Project at Corbin University with Professor Sean Hussey. Thank you for joining me. Ladies and gentlemen, fellow stakeholders, members of the board, thank you for taking the time to join me today to learn a little more about the current status of our business, Cameras R Us. Here are the topics we're going to discuss. Give you a little roadmap and so that you know where we're going. First, we're going to talk about our key metrics and how we've measured ourselves over the last 7 years or so. Next, we'll talk about the strategic vision for the company. We're going to set some upcoming performance targets. We're going to talk about our competitive strategy for entry-level cameras and then multi-feature cameras. We're going to talk about our production strategies in general. Then we'll move into finance strategies. We're going to talk about who our number one competitors are, and then we're going to talk about our strategy to deal with that, and then finally, our lessons learned. So, to begin with, let's review some of our key metrics, and I've included a slide here that works us from year 5 all the way through year 12. And the first thing you may notice is we begin year 5, whenever I took over this position, with a net revenue of around $200 million. And in year 12, we achieved approximately $722 million. And if you look closely at those numbers, you'll find out that's about 2.6 times the number we started with over a period of about 7 years, which breaks down to about 37% growth per year in net revenues. So I think that's pretty good performance. I'm pretty proud of that. I guess the next thing I would look at on this slide that I think is pretty impressive is our return on equity. Return on equity, we started out at about 15% here in year 5, and in year 11 and 12, we ended up quite high. Matter of fact, in year 12 we were at 52.5% in the return on equity. Stock price started out at about $30 in year 5, and then we ended up in year 12 at $207. Earnings per share in year 5 started out at $2, and in year 12 ended up at $11.21. So I'm pretty happy with our key metrics and our overall performance for the business. And with that being said, let's move into our strategic vision. So at Cameras R Us, we are honored that stakeholders choose our company to partner with. Because of this, we will always do our best to compete ethically, while holding the interest of our employees, customers, and shareholders in the highest degree. In order to do this, we will always strive to provide the best value entry-level cameras, provide the highest quality multi-level cameras, set the standard for employee consideration, be a leader in global environmental protection, and do what's right, not only what's most profitable. So our upcoming performance targets, a lot of our targets are based on a 3-year average, and most rolling 3 years, most recent 3 years. And so as you can see, for our net revenues, we're going to use $733.3 million, and that is based on a rolling 3-year average. As you can see, year 11 we were at $764 million, which is substantially higher than 733. But markets change, and we have to be flexible, and we don't want to set ourselves up for failure by aiming too high. So we want to be realistic about the goals that we set. Earnings per share, once again, our rolling average for the last 3 years is 9.9%. It'd be really nice if we hit something like this 11.2% every year, but 9.9 is not a bad target either. So that's where our target is. Of course, that doesn't mean we're not going to work as hard as we can to do better, but that's our starting point. Return on equity, kind of the same thing there. We've hit as high as 52.5% in year 12. I seem to think that that is unrealistic. We had great markets in that year. Some of the exchange rates were very favorable to us. And so just to set kind of a conservative target for year 13 and 14, we're going to set that at 45.3%. And again, that's based on past performance. So I'm pretty comfortable with that. Our goal on the stock price, again, $207 was our year 12 stock price. And I think if we work real hard, we ought to be able to maintain that, and that shouldn't decline. And that's pretty important. We're in a really strong position right now, and so we're going to try to maintain that, and then we're going to try to get about 6% growth on that between year 13 and 14. And so it's really some pretty lofty goals on stock price, but I think we can do that. Credit rating, as you can see, for 2 out of the last 3 years, we had an A+ credit rating. There were a few changes in the market in year 12. We slipped just a bit. Doesn't really concern me a whole lot. But moving forward, our current rating of an A is going to be our minimum targets, and hopefully we can actually get up to that A+. Image rating, for the last several years, we've been at 100, and so there's really no reason we shouldn't be able to continue to provide one of the better cameras out there and have some of the highest image ratings. So now we're going to talk about our competitive strategies. So on our entry-level cameras, there are some keys to remaining competitive in the entry-level camera market. First of all, we're going to create cameras that can be sold at or below the industry average. Our cameras aren't always the cheapest, but we want to be very, very competitive on price. Next, we want to maintain above-average warranties. We've set the standard for warranties on our cameras in this market, and we want to be able to maintain that. When someone puts their trust in us and buys our equipment, they should be able to count on that. Next, we're going to use above-average incentive bonuses to minimize warranty issues. So we're going to pay our guys a little more that are putting these cameras together, and that will result in a higher quality camera and therefore minimize the warranty costs and issues that we have. Next, we're going to have periodic improvements to core components, and what I mean by that is every once in a while we're going to upgrade things just a little bit, but we're going to keep our costs low on our core components in order to keep our selling price low as well and stay very competitive. Next, we're going to continue regular periodic sales windows. You are going to be able to find our cameras on sale for a couple weeks out of every quarter on a regular basis. Discounts are going to be about 15% during each one of those windows. So you're going to be able to count on that. So if you're a little bit patient, you want to save some money, I think you're going to be able to do that. Next, we're going to speculate on market shortages. It seems like sellers sell out of these entry-level cameras on a regular basis, and so we're going to produce a few extra and see if we can help ourselves a little bit. Next, we're going to maintain below-average administrative costs. In other words, we're going to keep our overhead low. And finally, we're going to maintain minimum available models. By maintaining 1 or 2 levels, we're able to increase our production capabilities and decrease our cost per camera. Next, we're going to talk about competitive strategy in our multi-level cameras. So here are some of the keys to remaining competitive in the multi-level camera market. We're going to create cameras with sales price above industry average, but not the highest in price. So we're going to be competitive. We're going to give you a great value and a great quality. We're going to maintain above-average warranties. Talked about that a little bit with entry level. We're going to use above-average incentive bonus to minimize warranty issues. We also already talked about that. We're going to use regular aggressive improvements to core components. So these are going to be some of the best cameras out there on the market. And then we're going to continue our regular periodic sales windows. We're going to limit production to sales forecasts. These are expensive cameras, and the market changes fast, so we don't want to be left with a bunch of these on the shelves. Next, we're going to maintain our below-average administrative costs, and we're going to provide a variety of available models. So, overall production strategy. When we're talking about how we compensate our people and how we keep costs down, the first thing we always think about is our overtime. Overtime is only used when absolutely necessary and only on a limited time basis. It is not financially efficient to employ this tactic often, nor is it fair to overwork employees on an ongoing basis. Another consideration in our production strategy is outsourcing. Outsourcing is an absolute last resort for production. Costs are always higher, and product cost quality is always lower. Therefore, our margins suffer. Typically, we will only outsource during the third quarter because it is our highest production period of the year. Expansion is another one of our production strategies. Expansion is how we grow our business, so these opportunities are sought after. But expansion will only be exercised when markets indicate a long-term debt is at or near zero and markets indicate payback periods of less than 7 years. Otherwise, we end up paying more in debt than we do in profits. So our finance strategy, dividends. Dividends are paid to investors as available based on the profitability of the company. Dividends are only paid after all long-term debt is paid off and enough capital is retained to cover operating expenses for the upcoming quarters. Lucrative dividend payouts encourage investors to participate, which in turn help maintain a strong stock price. Debt to equity. Long-term debt is never a good option for any business, including ours. Servicing debt robs the business of the ability to grow, reward investors, and to be competitive. Leveraging equity is the best way to grow and maintain a business. Of course, this requires strict fiscal responsibility with an unwavering attention to detail. Stock. Stock price is a direct reflection of our investors' confidence in the business. Every action and decision we make contributes to the price of our stock. Therefore, we must be judicious at every step. Issuing more stock dilutes the value of the current stock. It should only be done when the growth of the business justifies it. Repurchasing shares can also increase the value of existing shares and allow the business to retain more profits. But this can also result in overspending if done too aggressively or irresponsibly. And finally, credit rating. Our credit rating is a result of our operating condition as a whole, as well as our financial condition as a company. Little or no long-term debt and minimal short-term debt contribute greatly to a higher credit rating. This, of course, minimizes the cost of borrowed capital when needed and adds to the bottom line. It is imperative to maintain a credit rating of an A or better at all times. So competitors. Who are our highest competitors? Well, in the past, it's always been Company A. Take, for example, at the end of year 7, Company A was best in industry. Throughout years 8 through 12, Company A was second in industry. At the end of year 12, Company A led in market share in both entry-level cameras and multi-level cameras in Region 2, North America and Latin America. Company A also gained significant market share on us in all 4 regions in year 12. So as you can see, they are true competitors. So here's how we're going to outcompete Company A. First, we're going to focus on our marketing costs. Ours are 3 times higher, while our revenues are only 1.5 times higher. Dividends. We're paying dividends that are twice as high, so we might be able to be a little more conservative there. Sales price per unit. For entry-level cameras, they are 12% under industry average. We are 5% under. I don't know if we can fix that or not, but we're going to look real hard at it. Multi-level cameras, they are 46% under industry average. We are 3%. We need to find out how they're doing that and why. A little note, though, is acting versus reacting. Being number 1 in the industry comes with a price. Everyone wants to beat you, and they can react in order to do so. When you're number 1, your reactions are limited to the market. You're not reacting to competitors as much as you are the market, and that requires a lot of speculation. So you're required to lead and set the pace through action instead of reaction. So the main learnings for me through this exercise have been business leadership is complicated and multifaceted. A constantly changing market requires an unwavering attention to detail. Every decision made has a ripple effect, and the ripple is not always downstream. It can easily be upstream. Industry leaders are constant targets for market share gains and losses, and decisions need to be based on data, not intuition. You got to spend a lot of time looking at your reports. The business can operate ethically and still prosper. Thank you again for joining me.